Hey everyone, welcome to the KE Report, another daily editorial, this time chatting with Dana Lyons, fund manager and editor of the Lyons Share Pro website. I should mention Dana is running a holiday sale at the Lyons Share Pro, 20% off, and right now in this high volatility environment, good time to be a more active trader to hopefully weather some of those losses and take advantage of some of the volatility that we are seeing. Boy, oh boy, a lot of volatility this week, especially on the back of that Fed meeting. Dana, let's start off by just talking big picture about these markets. I want to get insights on what your internal models are telling you, simply because, look, the markets have had a great year. They've had a great couple of years. And we have seen periods of time where some of that upward momentum is lost. And early on this month, the markets were more or less flatlining with a little bias to the downside, but really not much. Yesterday, Fed meeting day, well, they disappointed the markets because we saw a big drop. And now I think that brings into question just how much more downside we could have. Dana, what are your models telling you? Is this the start of a bigger decline?
Thanks, Corey. I appreciate that. It's funny you mentioned the Fed because every morning in our strategy session videos that I send out to our subscribers on the Lyons Share, I put a couple of themes, major themes of the day. And on Fed Day, one of the notes was called Fed Up, meaning, more times than not, we've seen over the past few years that risk assets like to rise on a Fed day. This morning, I put a hyphen in between the F and the E to make it more effed up because they kind of spoiled the party. But it's not that you asked about our models. It wasn't a case that we couldn't see it coming from one respect. So coming out of the election, we saw a nice bounce in the broader market, contrary to what we saw going into the summer when it was very narrow rally, only the large cap tech stocks leading the way. After election, we saw, a broadening out, or really throughout the fall, we saw a broadening out of the rally where several sectors had emerged as relative strength leadership. We saw a broadening out of the small mid cap, some of the broader averages, which broke out to all-time highs or tested all-time highs. So that was a very healthy development in the market. A strange thing happened that, like you mentioned, entering December, where we saw some of the large cap averages, S&P continue to move to new highs, but we saw pretty distinct deterioration in breadth in some of the market internals. And what we've talked about in the past, a lot of investors like to talk about how price is truth, quote unquote. I like to say, yeah, price is truth, but breadth is kind of like a lie detector. So when we've seen in the past divergences within the indices and breadth where the indices continue up, but breadth starts to deteriorate and fall off, generally those advances in the averages are not sustainable. So we got to head not just anecdotally from those breadth readings leaking, but also speaking of leaking, that market data did leak into our quantitative models. So fortunately, our main risk model, intermediate term risk model, did give a sell signal for us at the end of last week. So gave us a heads up that, okay, once whatever the prevailing bounce is over, we could see a quick kind of back there. And certainly we did see that. And then that rally that we saw leading into the other day, not a sustainable one. So the lie detector test kind of worked again, but there is, looking out longer term, there is, still a lot of concern on our part from a longer term and even an intermediate term perspective, even if yesterday was a little bit overdone from a volatility standpoint.
So, Dana, when you say concern, does that mean going into a long-term bear market? Does that mean a crash scenario? Or does that simply mean maybe a slightly longer term, a multi-month correction in still that larger bull market or uptrend that we've been in?
That's a good question, and we've talked a lot in the past also about, durational perspective. So things, can be rosy in the short term, but not so much in the longer term or intermediate term. So right now it's kind of interesting. In the short term, panic levels hit an extreme yesterday, so I don't see in the near term volatility getting much higher, even though we'll have to work through this process. But we have seen in our intermediate term models, like I mentioned, a leaking or a deterioration in those components that make up that model, which in the intermediate term is a major warning that there could be significant risk out over the next several months. Now, that doesn't preclude, and if you look at strictly a chart pattern, it does not preclude new highs still in the S&P, for example. We're also seeing, some of the small and mid cap averages pull back and close that gap from just the day after the election. So there are technical reasons for a bounce, but just the intermediate term deterioration in some of the indicators that we're seeing give us major concern about you asked what kind of a top, about a major top and even a longer term bear market top. And the reason I say that is because of even the longer term, if we even zoom out even more, the longer term backdrop of this market has rarely ever been this risk laden. You look at metrics, which we call background indicators, long term measures of valuation, long term measures of investor sentiment or investor money invested in the markets, and just the level of where the indices are versus their long-term trend. There are few, if any, periods historically where we've seen a combination so extreme, so excessive that we see right now. You can even look at something like the Buffett indicator, market cap to GDP hitting all-time highs. So I don't see a crash right off the bat. It's not going to be a straight line. There'll be a process of chipping away at kind of the foundation of the market. But we do see not insignificant risk of a major top occurring maybe over the next year or so. And again, given the amount of risk in those background indicators, it could be one of the more serious bear markets that we've seen, in recent decades or perhaps ever. I don't know.
Interesting. Does that mean that we see a more concentration of capital into tech like we've seen over the last couple of years, where once breadth declines, money seems to just go into tech for a safety play, or is there a different play?
I don't see tech as a safety play. There are pockets of tech that I think well positioned or okay positioned. Obviously, Apple continues to do its thing. Cybersecurity has been good to us. Some of the software names have been solid. But other areas in tech, I'd be concerned that have already topped out. I mean, semiconductors were short. We were short coming in to this week, so that's helped hedge the downside for us a lot. I would be concerned about things that are significantly below those highs set in July, August, which aren't that many areas, but a lot of them are in tech. So I would not be looking at tech as a safe haven. I think some of the defensive sectors that began to emerge after the summer and are still in pretty good position might be some defensive names, but that would be in the interim. I mean, once we hit the meat of the bear market, obviously nothing equity wise would be safe. But I think before we get that there, you could continue to see higher highs in a handful of sectors, certainly. So it's like I mentioned, I don't see us crashing from here. I don't see a straight down move. There was enough from a price perspective, technical perspective, enough of a foundation put in where it's going to have to chip away before things get broken down and susceptible to really the meat of a serious bear market. So we're not going to go from point A to Z just like that, but I would say concentrate on those areas that have continue to hit higher highs and higher lows, and avoid the ones that are, significantly below those summer highs.
Dana, what about historical considerations here? We do talk seasonality with you here and there, but more on a historical reference of coming into a new year, new administration, markets that have already been up 20+% just in the last 2 years, each of those last 2 years. Any historical considerations that you're factoring in here?
Yeah, well, from a presidential cycle, I think things are okay. Um, I try to leave politics out of certainly any investment decisions that we make because it has really no bearing if you look at different administrations. Historically, there's more of a pattern, a 4-year pattern within just the generic administration. And usually the first year is pretty decent. So from that perspective, that would not add to our concern. In fact, the first half of the first year is generally pretty darn good. And then, our seasonality around year end is pretty good typically. One seasonal pattern that we discovered ourselves, over the last decade of research that might come into play, that might be, a check in the bullish box would be these volatility spikes in December, almost without fail. When we see big spikes in the VIX in December after coming off a low in the VIX, of a substantial low in the VIX. Generally, by the end of the year, we see pretty solid gains in the averages. So I know there's not a whole lot of time left in the year, 2 weeks or so. But from that perspective, that would kind of add more fodder to the notion that maybe volatility got a little overdone yesterday. And I don't see it. It could make a slightly higher high, but I don't see it really going much higher. And from the same notion, could see after a couple of days, could see a decent bounce into the year end. I'm not sure, but that would be one seasonal pattern that has held up almost every year. 2018 was dicey in that regard. We were in kind of an intermediate to bear market at the time, but you did see, I think it was Christmas Eve, bottomed out and had a nice strong rally the last week. So that's just all possibilities. I like to stick to our quantitative data, but those would be some from a seasonal or historical perspective, some slight tailwinds, certainly at the back of investors, but certainly the Fed again threw a wrench, or at least the post Fed market action threw a wrench into some of these seasonal or end of the year seasonal patterns.
Dan, I know you always look internationally as well, and one thing that I think we can all say is that there have been some bright spots in terms of international markets, but the U.S. markets have been so strong. I think it's also distracted a lot of people. Are you seeing any life in certain individual markets? And again, that big picture view of are emerging markets, are smaller markets, are any other markets going to take over a bit more attention from the U.S. markets if we do get into more of this downtrend?
That's a possibility. I would have to see proof from prices for sure. Like I mentioned, in the fall, we saw broadening out of domestic sectors and domestic market segments. We also saw broadening out of international markets, which many of which did rally to all-time highs. We've seen kind of a stagnation since then. We're not seeing a whole lot in terms of bright spots internationally right now. And it's especially tough for U.S. investors in international equities that are especially using domestic ETFs on those international markets because of the recent resurgence in the dollar is really kind of decaying any benefit from rising prices in international stocks. Just the currency effect is really making things tough right now for U.S. investors in those markets. I guess the one bright spot continues to be the bright spot that we've talked about, I think, on the show for a couple of years now has been Argentina, which really just has shown no propensity to stop its rally. A lot of good things going on in that country. I think fiscally, politically, maybe leaking into the stock performance but that's kind of the exception in terms of some of the, like I mentioned, domestically based international ETFs. So that one's been able to buck the trend, but you are seeing a lot of negative currency effects given the recent bounce in the dollar.
All right, Dana, we'll wrap it up here. Look, it's always a pleasure chatting with you and really seeing what your models are telling you. And it sounds like they, again, started to roll over right before these markets started to roll over. And this week, especially yesterday, is sure having some people reconsider that almost unanimously bullish outlook for the markets as we headed into the end of the year. And again, all just on the Fed. It seems like lowering some of their projections for rate cuts for next year. That's why you got to follow the charts, and that's why I like following along with you, Dana. Again, Dana is running a holiday sale, 20% off at the Lyons Share Pro. Click the link in the show notes to take advantage of that discount. Dana, thank you for all your time this year. Hope you have a very happy holiday season. Merry Christmas, Happy New Year, and I'll chat with you in 2025.
Thank you so much, Corey. I appreciate your work, appreciate your relationship, and happy holidays to you and all of the listeners out there. Appreciate you all. Thank you.